SEBI finally fires the bullet, introduces curbs on trading and derivatives. We get you the details on the show. Market ends flat as Reliance and ITC drag the indices lower. Nifty Auto hits a record high. Intraday, mid and small cap indices hit record highs. The Finance Minister responds to budget debate in Parliament, rejects opposition's criticism of the centre favouring certain states in Budget 2024. Prime Minister Modi calls on the private sector to participate in creating Viksit Bharat amidst a discussion on the need for private capex to pick up. Commerce Minister Piyush Goyal, though lashed out at the industry representatives, he said industry must work with government, saying tali do haath se bachti hai. Manu Bhaker and Sarabjot Singh clinched bronze at the Paris Olympics. Bhaker scripts history by becoming the first Indian woman to win 2 medals in a single Summer Olympic. MapMyIndia sends legal notice to Ola Electric, alleges that Ola Maps copied the data and breached the agreement. Ola Electric denies the allegations, calls them false, malicious and misleading. Adani Wilmar reports strong first quarter earnings. EBITDA jumps 375%, while margins grow by over 3%. Volumes grow 12% compared to last year. 84 people are killed and hundreds still trapped after 3 landslides hit Kerala's Wayanad district amid heavy rain. Rescue operations underway. Good evening and welcome. You're watching The Big Story on NDTV Profit. I'm Nupur, Talwar, Suri. Well, the big story this evening, of course, is the SEBI releasing a consultation paper to curb speculation in the F&O trading. Now, Sajeet Manghat is joining us in the studio with more details. Sajeet, top of what we can understand of this paper that has been released is that SEBI has listed about 7 steps, including increasing the minimum contract size for F&O to 20 lakhs. And limiting weekly options contract. Give us more details of what you understand of what has been said in the paper.
To set the context here, we've been looking at most of the regulators talking about the fact that there's excessive speculation which is there in the derivative market, and the fact that a lot of money is from the household saving is now getting channelized into the derivative market, and that's creating a issue for the regulator on a macro side. And that's the reason why we had SEBI talking about it, and then SEBI under the in the secondary market advisory committee, which looks into the market policies, created an expert working group which consisted of brokers, exchanges, experts to look at how to curb this entire excessive speculation, and they came out with a regulation. And now SEBI has come out with a consultation paper, which is a public process for any policy decision made by the regulator, and they have come out with 7 key things. The first being that the strike intervals. Now, for people, strike intervals are those, if the index is say at 100, at what interval you have the contracts available to the investor. That's a strike interval which we are talking about here. And SEBI says that while strike intervals will be smaller, up to 4% either ways of the index, it will expand post 4%, and that would mean that the cost will also go up for the investors who are looking at taking positions beyond 4% from the index level at any point in time. The second one is basically the number of strikes that's available. Earlier, the regulation was that 35 strikes were available on either side of the index, 35 on the higher side and 35 on the lower side. They've now reduced it to 50 strikes at any given point in time, and it will be done it will be adjusted on a daily basis by the regulator if this proposal goes through. The third one was the upfront margins. Now, when you do an trade in the market, you have to pay margins. In the case of options especially, many of the members, clearing members were paying margins to the stock exchange and clearing corporation. Now it has been made mandatory for the clients who are trading in options to give upfront margins to the stock exchange and clearing corporations, and that is something would be much more hurting, because today if you are trading in an options market, at the end of the day you would end up paying a margin on it, but now before you make a trade you have to put the money upfront to the stock exchange or clearing corporation there. There is another thing which has been brought in, which is a calendar spread for people to understand. It's basically taking a position in current month by selling current month and then buying in the next month, and the spread which is there had a lower margin component. Now they are doing away with calendar spread on expiry day, which basically means that speculation and arbitrage which they were trying to do, they're trying to bring down that thing. The biggest impact would be the minimum contract size for index derivatives. Any new stock or any index which is going to be introduced will have a lot size of between 15 to 20 lakh rupees. Now, to give a perspective, today it is between 5 to 10 lakhs, so almost doubling of the lot size which is there, and this lot size will be increased to 25 to 30 lakhs after 6 months of the introduction of the contract. So basically what the regulator is making 3x more expensive for retail investors to come and trade in the market there. There is some bad news for the stock exchanges as well, because some of the products of stock exchanges are going to be rationalized. Like NSE had 3 products, BSE had 2 products which were weekly option expiries. Now each exchange will be given 1 benchmark to expire a week. That means there will be only 2 weekly expiries, one from NSE and one from the BSE. There's other measures which is increasing in margins and all, which makes life little tougher and higher and expensive for retail investors. The big thing is that in FY24 there were around 92.4 lakh investors who were investing in the futures and options market. 85% of them were making losses, and these losses were to the tune of over 50,000 crores, which SEBI's concern is that only 15 out of every 100 were making some kind of profit, and the profits were also being taken by mostly by the proprietary traders. So the impact of this would be on immediate volumes which is coming from retail investors and proprietary investors which is there. So, if you look at some of the NSE data, it shows that, some of the average ticket size or the trade size, it was around 6,000 rupees odd in the options market. Now, if this rules comes into play, it will go up to 3x or 4x the size, and that would mean that it becomes much more expensive to trade in an options market and speculate in this market.
Right, absolutely. Sajeet, do stay with us. Also joining us on the broadcast is Mr. J.N. Gupta. He's the former ED of SEBI. And also joining us is Deven Choksey, the MD of DRChoksey Shares and Securities. Mr. Choksey, to you first. What do you make of these guardrails, so to say, that have been put in place, or likely rather to be put in place by SEBI?
Yeah, good evening. Well, I think the intention of curbing the speculation is not denied under the proposal which has been brought out. However, I think the strong apprehension whether it will probably result into the reduction in speculation, answer is no. There is going to be a side effect to this. On one side, we are talking about increasing the size of the market lot. I think increasing the size of the market lot means that I think there is going to be a significantly high amount of encouragement to the people to go to dabba trading. Second most outcome would be that instead of trading in this derivative market, the market participant would start trading into small cap and mid cap stocks where the liquidity driven push is easy to obtain. So honestly, I think those liquidity-driven push, I think, which are basically going to be the resultant outcome in the small and mid-cap stocks will probably make the valuation of the small mid-cap stocks even more crazier. And last but not the least, I think by creating the size of the contract, I think, which is larger, we are forgetting one thing, that today the market capitalization is $5.5 trillion. This market capitalization in next 10 years is going to become $12 to $15 trillion. if this is going to be the reality, then whatever may be the size of this market lot that you are creating today, you'll only be increasing day by day going forward. So that is not a solution. That is not a liquidity created solution in the marketplace. I think you may curb the speculation on one side, but whether it will result into liquidity creation in the marketplace, I think the answer is big no. So I think the proposals are proposals. Maybe I think they have to be discussed in a fair manner, so that at least I think the resultant outcome can come as a win-win for both, curbing the speculation as well as increasing the liquidity in the markets.
Deven bhai, if you look at some of the statistics which is available on the NSE, the average trade size in the options market for retail is around 6,000 rupees. Do you think that trade size will now have to go significantly higher if they want to continue trading in the options market?
So the retail will not come to options market, Sajeet. I think that is a simple answer. And if you create the hurdle, I think they will not come to option market, but I think they will go to the other markets, which I just now explained. And that is going to be even more dangerous. So I don't think that I think one has solved the problem in totality. One has possibly tried to create a speed breaker on the road so that the speed comes down. But I don't think that the problem is solved.
A shift of volumes from options market to, as you said, to the cash market, especially in the mid cap and small cap, isn't it little better than the kind of speculation which was happening in the options market?
100% better, but at the same time, I think those small and mid cap stocks on which I think this volume will get shifted to, they will go into a crazy drive. I think they will probably command valuations which are going to be even more crazier. Because understand one thing, that small and mid cap stocks today, the rally is driven purely by the liquidity constraint. Today these stocks do not offer the enough amount of liquidity, and as a result of which people with money back, they play around in this particular counters, create narratives, and ultimately create crazy valuations. So this is not going to stop. On the contrary, I think it will make even genuine investors affected in the stock market, because I think the valuations will go completely crazy in some of the small and mid cap stocks where the liquidity is a concern.
Right, Mr. Choksey, do remain with us. Let's also bring in Mr. J.N. Gupta on this. Mr. Gupta, what do you make of these proposals that have come out? Now, SEBI has, of course, listed 7 steps. These include increasing the minimum contract size for an FNO to 20 lakh rupees, to limiting the weekly options contract. We just heard Mr. Choksey. He feels that, it doesn't really solve the entire problem.
First of all, I'm thankful to Mr. Choksey for doing such elaborate analysis and telling all the viewers everything. I heard him and I have a couple of points. One is this: no proposal can solve all the problems. So it is not. So let us see what is the big problem which SEBI was trying to address. The big problem that SEBI had is very simple. SEBI, one of the foundation principle of SEBI is protection of investors. Now, protection of investors is generally protection of investors from the fraud done by others. But it is a typical case where protection of investors is from themselves. Because what is happening in the market, many people, say for example, what Mr. Choksey talked, what you were talking, your correspondent was explaining. Take a sample of 10 people individual retail investors who deal with the options and future, and ask them to explain what was explained to them. I bet my life that 9 out of 10 would not understand anything. So the problem before SEBI was that how to save those investors who are bent upon committing harakiri. I would agree that it could have a repercussion on cash market, it could have repercussion on the dabba trading, whatever it may be. But then it is a problem that was facing SEBI in a big manner. And what is happening in a country like ours, where everything becomes a political issue, it is very important that this thing is handled, because as I was seeing, that so much commission was, a premium was there. If you look at into the SEBI note, there is a lot of premium that has been paid. Now, this premium has come from this, and if you see the analysis, 9 out of 10 investors, if you account for premium, are losing. So this is there. So idea of SEBI is not to do anything. Here it is setting a big problem and probably creating a small ripples in other. Now, there you cannot say that I will not handle the big problem because there is going to cause smaller problems. So that is one part. The second thing is very clear that it is an attempt by SEBI, one, to educate the people that it is a risky thing. Secondly, trying to limit the entry by increasing the lot size, by making sure that the margin is in cash, that you have to put upfront margin, stopping the calendar margin issue, all being small steps. So I hope that this is going to bring some sort of a semblance in the market. As Mr. Choksey said, probably if somebody has to play the jua, they have to gamble, they will go to the cash market, they will go to mid-cap market, they will go to commerce. So you cannot stop all 100 people from committing harakiri. I would say out of 100 people who are committing harakiri today, if you stop 20 also, those 20 families would be safe. Because I have come across cases where people have borrowed money without understanding anything. They have borrowed money and put into the options in future, hoping that they will make quick buck. And that is the reason SEBI is right in trying to tighten the entry.
Mr. Gupta, we've reached here because SEBI allowed those products to come into play, right? At the time of a product being approved by the regulator, these kind of analysis should have been done. Now we are trying to backtrack on those products.
No, I wouldn't say. I will tell you something. See, every development has its positive and negative. Now tell me, if Alfred Nobel, in whose name you give Nobel Peace Prize, if he had known that his product, his dynamite, can cause havoc all over the world, probably he would not have developed the product. Any gun maker would not have developed gun because the gun kills people. So you start a product with an objective. The objective was to give choice to the people. Objective was to develop liquidity into the market and all other things. Now, if it so happens that objective is met partially, but it is bringing some negative things. Now, there are two options that will be available. Either stop it or try to modify it so that you address the problem. So I would say it is the first step SEBI has taken from SEBI. Second thing is this, that when I start a product new, I don't have data available. Now here, after all the 7-8 years, there is a solid data available, and this data analysis to the granular level has come to a result where SEBI feels, after taking expert advice and participants of the market, brokers, investors, everybody, that this is the right thing. How far it is successful, how it will fail, one doesn't know, but I hope that it will be able to limit the participation of people who are vulnerable. The idea is to save vulnerable people. If somebody has 1,000 crore to burn it, I don't care. But if somebody is burning his house to play in the market, certainly not correct.
Deven bhai, what do you have to say about the fact that now they're going to allow only one benchmark index weekly expiry per exchange?
See, I would say I am not expert on all that thing because I don't do options and futures trading. But I would say since it is being done after the consultation from the participant and experts, it would have been a really thought over decision that SEBI has taken.
All right. Mr. Gupta as well as Mr. Choksey, thank you very much, both of you gentlemen, for joining us and bringing us those insights into what this could mean. We slip into a very short break here on the big story. When we come back, Agam Vakil will be joining us to share his insights on what this could mean for the FNO segment. Welcome back. You're watching the big story on NDTV Profit, and the story that we are focusing on this evening is where SEBI has now released a consultation paper to curb speculation in FNO trading. In fact, it has suggested about 7 steps to deal with the situation, and Agam Vakil is also joining us. He tracks the FNO segment closely. Agam, hi. What's your take on this latest consultation paper, and I'm sure you heard those two gentlemen earlier on the show. They seemed to be on the opposite sides.
Yes, Nupur, I actually did have a chance to speak to a handful of other participants too, and well, it certainly is a mixed reaction. The first 2 pointers that talk about option strike rationalization and upfront correction from option premiums, specifically when it comes to buyers. Well, a lot of these participants are suggesting that this is not as much as to curtail retail participation, as much it is making sure that the risks that these retail participants take are well in order and they don't go ahead and bust their accounts, so to speak. When it comes to certain other margin requirements, yes, they are a tad bit more towards discouraging retail participants. So something like the removal of calendar spreads, specifically on the day of expiry, or something like increasing the margin when it comes to near time expiries. What I mean by this is that as you get closer to an expiration of an options contract, what really happens is that option premiums continue to become smaller. And when they do become smaller, it's a riskier proposition for option sellers to perhaps go and place bets on relatively smaller premiums. What this means is that if things go wrong for some of these option sellers, naturally, well, they will likely lead to substantially high losses in comparison to the potential profit that they can make. And if you, in fact, increase the margin requirements, that will lead them to perhaps take smaller positions as far as your near-term expiries are concerned. About the aspect of sending a lot of these option players down to cash markets in mid-cap and small-cap markets, well, some of these participants are suggesting that is actually unlikely. The reason why they say this is because options requires leverage, and it gives you easy leverage. In fact, you don't have to pay for the debt that you're pulling up in order to take those positions. So while you can, in fact, take a position which is 2 times, 3 times, even 10 times in an options market, you cannot do that in your cash markets, even if it is a mid-cap or a small-cap stock. So the proposition of the movement of a lot of these option traders going to mid-cap and small-cap cash markets is less likely, according to the participants that I've spoken to. But yes, this is largely what I have been making from the conversations I've had so far.
Right, absolutely. So, Agam, the intent essentially is to curb speculative trading, at least for retail investors who are at the lower end of the spectrum. We'll have to wait and watch out for how much of these are actually adopted. Agam and Sajeet, who's with me in the studio, both of you gentlemen, thank you for joining us. Well, with that, it's a wrap on this big story. Thank you very much for joining us on NDTV Profit.